High after high getting taken out. Resistance after resistance. Whether you short or not, dollar yen just printed a fresh 32-year high. The last time price was trading at these levels was back in 1990. What the hell is going on? What is happening, everyone? Happy Saturday. Welcome back to the channel. Dollar yen, the notorious monster, shall we call it, of the current narrative. Dollar yen breaking every single high possible, with the thoughts of it possibly slowing down at 144 with some Bank of Japan intervention. Still no budge whatsoever. Dollar yen currently at 148.70. Massive rally this past week. I'm here to break that down and tell you why that is still happening and why the Bank of Japan are not fucking doing anything. Right, straight into the charts. Dollar yen right now on the 3 monthly time frame, just to give you a broad picture of what is actually going on. Looking at this on the higher time frames, we can see, in terms of technical analysis, a beautiful little inverse head and shoulders over there, with the left head, right shoulder holding up at around that 100 mark. There was a neckline at around 124, which obviously we've snapped through. Let's go ahead and draw that in. Obviously, we've snapped straight through that one over there. Now, that being said, when you do have a head and shoulders, you can measure from the head to the neckline to get a target. Let's go ahead and do that on the video while we're together. From the low to the high, right? Just clone that level. Go ahead and put that above the neckline. In terms of technical analysis, this shows us that dollar yen could reach levels of 175. Now let's break down the fundamentals. Looking at something that's called the Japanese 10-year. I just want to show everyone something on the 4-hour time frame. Let's go to the daily. There we go, that's better. Daily time frame on the Japanese 10-year yield. This is something known as the 25 basis point line in the sand for the Bank of Japan. The Bank of Japan do not like their bond yields going past 25 basis points. That's 0.25% on their yield. They can't afford that, right? They have a mandate in place that should the 10-year yields go above 25 basis points, or 0.25, they will buy bonds to bring that down. Given their most recent statement, the fact that they're willing to do an unlimited amount of government JGBs, that's Japanese government bonds, an unlimited amount, that is sending the yen to extraordinary lows. You may be thinking, if it's sending the yen to all-time lows, why isn't that good for the currency? That's cheap to borrow, cheap to spend. In fact, that's putting a lot of pressure on imports. Think about it this way. If you rely heavily on importing energy and your currency is devalued that much, it's costing businesses a lot more. So looking at that right now, with the Japanese 10-year being firm at this 25 basis point handle, we know that there's a current narrative of global yields soaring. Let's take a look at the US 10-year, the US 2-year and the US 10-year soaring, right? If there is a global yield frenzy and all global yields are rallying because central banks are raising rates, we have a problem here. We do have a problem here. So what this tells me is, if the Federal Reserve continue to raise rates, 2-year and the 10-year on the front end are going to continue to rally. This is going to send dollar yen higher. I want to show you the 10-year for a second, and I'm going to get dollar yen on the other side. There we go. Let's close that for a second. Notice how the 10-year yield on the left and dollar yen on the right are extremely correlated. You have your peaks, you have your troughs, but so does dollar yen. So what this tells me is, if I go ahead and get the Japanese 10-year on the right, let's put that on the daily, we can see that there's a massive level of resistance here at 25 basis points. If global yields continue to rise, the Japanese 10-year is going to continue to have an attempt. Let's get it up on the left-hand side. The Japanese 10-year is going to continue to have an attempt at the 25 basis point upper limit. If that is the case, the Bank of Japan are not going to be able to intervene on the yen's devaluation. So what that means is, if the 10-year yield continues to rise, because the Fed are going to continue on their path of raising interest rates, which we know is the narrative, that tells us that the yen is going to continue to be devalued. The Bank of Japan can only afford to stop bond purchases if the Japanese 10-year eases off of this level. We've seen that before. We've seen it in the past. That is the current problem that we're having. The fact that they've committed to an unlimited amount of bond purchases to assist the yields, we're sitting with a problem. So I still do favor some yen intervention, right? Called yen intervention. I do still favor that. We saw that at the 144 handle. But my only concern is if this yen intervention was strong enough, surely we would have cracked lower and held below the 140 handle. But the fact that global yields are remaining a problem, the fact that the Federal Reserve has reiterated that they're going to get rates to 4.5% to 5% within the space of the next 3 to 6 months, that's putting a lot of pressure on global yields. The fact that global yields continue to soar, I'm afraid dollar yen isn't going to be the best short right now. So for myself, I do think we may have an ease off in price. I do feel this is irrational. I do feel this is just a squeeze, given the fact that on Friday we know Fed member Daly confirmed they're going to get rates to 4.75 basis points, right? 475 basis points to then see how the market reacts. The minute the Fed cool off, a slight little cool off, you'll see the 10-year and the 2-year pull off the highs, and more than likely dollar yen does the same, because you'll see the Japanese 10-year cool off. That means the Bank of Japan have less pressure to stay away from that 25 basis point upper limit. But guys and girls, I hope you enjoyed this breakdown. This breakdown simply means dollar yen intervention, and the yen intervention is not going to be our best play until the Federal Reserve cool off. They are currently 175 basis points away from their cool off zone. If they raise rates in November, on the 2nd of November by 75 basis points, that'll take the interest rates to 4%. What that might do for us is have one more little push up higher on the yen pairs. However, if they do cool off February, March next year, we are going to see a cool off in the yen pairs, and that'll give us a beautiful little short on dollar yen. Till then, I am eagerly waiting just as much as you are, but 32-year high. Massive, massive level. Hope you guys and girls enjoyed this video. Do like, comment, share, subscribe. Stay tuned on the channel. There's so much more to come. Hope you have a great weekend, and I'll see you soon. Take care. Bye-bye.